Now that Impervious has gone through the whole cycle, they calculated their variances, they've booked the flow of costs through inventory at the standards that they set forth at the beginning of the period, and then used the difference between their actual results and the amount they booked at standard to put their transitional variance accounts on the books. All of those variance accounts need to go away. Their purpose is to track how much we missed our estimate by for this period and only for this period. And since they're no longer needed, we need to transition them from having a balance to being zero, to getting rid of them. And we're going to do so in one big gigantic closing entry here. So we're going to record our closing entry on December 31st, and I'll call it CLO for closing, to close all of our variance accounts. Well, how am I going to do that? Well, we should go to our journal and see what we did in our entries to start with. Like, what would the balance of these accounts be? Direct material price variance got credited for $1,550, which means at this time its T account has a $1,550 credit balance. We need to get it to zero. So how would we get that T from having a credit balance of $1,550 down to zero? We would debit it for the same amount. So I'm going to go to my closing entry, and I'm going to make a debit to direct materials price variance, and that is for that $1,550 credit balance that it has. And now when I make a T for this, its T account will have a balance of zero. Back in our journal, it just so happened, or we can look at our variances over here, it just so happened that that is the only favorable variance that we put on our books. All of our other variances, our direct materials efficiency variance, both of our labor variances, both of our variable overhead variances, both of our fixed overhead variances, they're all unfavorable. They all were recorded with a debit when we put them in the journal entries, which means to get those accounts down to zero, we need to do whatever it takes to get that thing to null out. We need to credit those T accounts for the same amount that they currently have a debit balance for. And we're going to do that by going back to our closing entry. I'm going to skip a line, and I am going to start closing out each and every unfavorable variance that we recorded in our journals during the period. And the first one was our direct materials efficiency variance. And our direct materials efficiency variance was for originally a debit of $1,500. So if I credit it for $1,500, that account's balance is now zero. We've got a direct labor price variance. Again, our price variance originally had a debit in the journal entry. Its T account will have a debit balance, and it is for $1,028. Well, we need to close it for that same amount, so we're going to credit for that amount. We had a direct labor efficiency variance, and our direct labor efficiency variance in our journal entry was for a debit of $2,100, so we need to credit that account for $2,100 to get its T account to zero out. We had a couple of variances for variable overhead. We had our VOH spending variance, if I could type, and our variable overhead spending variance had a debit in our journal entry because it was unfavorable. So that VOH spending variance right there with a debit balance now of $400 is going to require us to credit that account for $400 to reduce its balance to zero. We had a VOH efficiency variance and our variable overhead efficiency variance in the journal entry to allocate out that overhead was debited for $560, like all unfavorable variances. To get it to zero, we need to credit that account for the same amount, so we're going to credit VOH efficiency variance for $560 in our journal entries. We've got fixed overhead spending variance is the next guy on our list. If we go to our journals, we see that our fixed overhead spending variance was unfavorable by $800. That account has an $800 debit balance. To get it down to zero, we're going to have to credit it for $800, which we're going to do in our closing entry. And then lastly, we have the very long name of fixed overhead production volume variance. And our production volume variance for fixed overhead, according to our original journals, was $500 on the debit side because it was unfavorable. we need to credit that account for the same 500 to reduce its balance to 0. And at this point, we have a whole bunch of credits and just this one debit to direct material price variance. And again, the reason for that setup is because we did the opposite to every one of these accounts that we did when we recorded the journal entries originally. Direct materials price variance was the only variance account we had in our normal journal entries, which was credited because it was our only favorable variance. All the other ones, since they were unfavorable, were debited in journal entries, and because they were debited in the normal entries and they would have debit balances, to reduce them down to 0, we would need to credit all of those in the closing entries. I'm willing to bet right now that our debits don't equal our credits. In fact, I would guarantee it, because there's a whole lot of these guys, and one of them is even bigger than our only debit, which means we're going to have to debit something to make our debits equal our credits in this journal entry. And whatever that something is, we're going to have to debit is going to have to be for $5,338. Does that number look familiar to us? Well, if I go back to our standard cost income statement, that was the total amount of variances that we had. It was in fact the amount that we had to increase our cost of goods sold by from the amount we recorded as standard to get it up to its actual amount. We are going to close each and every one of these variance accounts to our cost of goods sold, and I'm glad that it's a debit, because that's what it should be, because we increased our cost of goods sold on our standard cost income statement. It was greater than our actual cost of goods sold was greater than it should have been according to our standards. We need to increase COGS, and COGS is an expense account, goes up on the debit side, so I'm glad that we needed a debit. And now our debits equal our credits, and we are done preparing our closing entry, which closed our variance accounts to our cost of goods sold account, to COGS.